The US has slapped massive tariffs on Chinese goods. But who really pays the price? China, America, or you? Your phone, your laptop, your furniture. What do they all have in common? They probably come from China, and now they're caught in the middle of a trade war. China is fighting slowing growth. America is fighting inflation, and tariffs are making both struggles harder. Hello and welcome back. The US has imposed a series of increasing tariffs on Chinese imports, part of a strategy called reciprocal tariffs, i.e., applied to countries with large trade surpluses with the US. On April 2, 2025, for example, the US applied a 34% tariff on most Chinese imports. This is in addition to earlier tariffs, like the fentanyl tariff, universal tariffs, etc. China responded with its own tariffs on U.S. goods, agricultural products, soybeans, pork, beef, etc. It also used non-tariff barriers, investigations, licensing, regulatory scrutiny in some high-tech or critical sectors. Chinese exports to the U.S. have fallen significantly in 2025. According to Chinese customs data, in the first 8 months of 2025, two-way trade was down about 14.4% year-on-year. Exports from China to the U.S. fell faster, about 15.5%, than overall Chinese exports. The U.S. has moved from being China's top single-country export destination to falling behind some other regions, though still large. U.S. firms are scaling back or delaying investment in China due to uncertainty about these tariffs and regulatory risk. The USCBC, U.S.-China Business Council survey shows many companies have lost sales or expect losses and are altering their supply chains. Also, trade is redirecting. Chinese firms increasingly exporting to ASEAN countries, the EU, and other markets to make up for lost U.S. demand. China has introduced stimulus to try to cushion its slowing growth. The stimulus includes boosting consumer spending, increasing lending, opening up certain sectors, health, leisure, improving market access, tourism, etc. Also, regulatory or trade investigations have been launched targeting U.S. firms and industries, especially in semiconductors and exports. The U.S. Treasury has noted concerns about China's yuan exchange rate. While the yuan has strengthened slightly against the U.S. dollar in 2025, it has weakened significantly against the euro, which has led to implications for China-EU trade. Now let's talk about the impact of tariff on both countries. China. Slower growth in export-led industries due to reduced U.S. demand. Consumer spending has weakened, industrial output is slowing, additional pressure on the already fragile property sector, job market stress, need for domestic stimulus to offset external weakness, risk that retaliatory measures may damage Chinese firms' access to U.S. tech or markets. USA. U.S. businesses and retailers importing Chinese goods face higher costs. Many are considering or shifting supply chains. U.S. consumers may pay more for various goods, like electronics, furniture, household goods due to tariffs. Exporters, notably agricultural producers, suffer from Chinese retaliatory tariffs, fewer markets, or lower competitiveness in China. Trade policy uncertainty is undermining business investment decisions and causing delays. Risk of broader global economic slowdown if U.S.-China trade shrinks large enough. The WTO has warned the bilateral trade could drop significantly. In the end, tariffs aren't just about numbers on a spreadsheet. They're about people, jobs, and the future of the global economy. The question is, who will pay the real price? The US-China trade wars show us one thing clearly. In a globalized world, no country fights alone. Every tariff set in Washington or Beijing echoes across factories and homes worldwide.